In last week's video, I introduced the concept and the idea of inheritance tax. I'm going to be building up on that video from last week and talk about the history of it and some exemptions that will help you in your tax planning. Now, inheritance tax was first introduced in the United Kingdom in 1986. It replaced the old capital transfer tax, and we've got to bear in mind that inheritance tax is predominantly a tax on the transfer of capital value. It's applicable on the death of an individual. It's applicable on lifetime gifts where the donor dies within 7 years of making that transfer of value, making that gift. And it's also applicable on some lifetime gifts which are taxed immediately. Spoiler alert, we tend to be talking about gifts into trust or transfers into trust. Now, not everybody will pay inheritance tax. It's only due if your estate, which includes any assets held in trust and gifts made within 7 years of death, is valued over the current inheritance tax threshold. Now, it's worth noting, by the way, that threshold currently $325,000 goes back to 2008-2009, and if it was index linked at 3% inflation over the last 15 years, it would be worth effectively $506,000. Or if you take into account the erosion of inflation at 3% per annum, it's only worth $208,000 approximately. So you can see that hasn't kept pace, and the threshold is frozen until 2028. Tax is payable at 40% on the amount over this threshold. Now, there is an increased threshold limit, by the way, for married couples and those in civil partnerships. Married couples and registered civil partners can effectively increase the threshold on the estate when the second partner dies to as much as £650,000. And that applies from 2009 up to and including 5th of April 2028 in the UK. The executors or PRs or personal representatives, if you want the full expansion, must transfer the first spouse or civil partner's unused inheritance tax threshold or nil rate band to the second spouse or civil partner when they die. That assumes, by the way, the entire estate is gifted across. Gifts that are also exempt from inheritance tax is what I'm going to look at next. Now, it's worth noting, folks, that if your estate is worth more than the IHT threshold, excuse my abbreviation, $325,000, then there are some important IHT exemptions that allow you to make gifts to others and not have to pay tax on them when you die. Not that you might be worried about that when you die, but your beneficiaries and those who survive will be. Now, you can make gifts to certain people and organisations without having to pay any IHT. These gifts are exempt whether you make them during a lifetime or as part of your will. And you can make exempt gifts to the following: your husband, your wife or civil partner, as long as they have a permanent home in the United Kingdom. UK charities are also included. Some national institutions such as museums, universities and the National Trust. Those are just 3 examples. UK political parties that are recognised as such, gifts that you give to your unmarried partner or a partner that you're not in a registered civil partnership with, unfortunately are not exempt. Now, this is not necessarily saying that's a good reason to get married, but getting married does have certain tax benefits. Now, let's talk about the annual exemption. Now, you can give away gifts worth up to £3,000 in each tax year, and these gifts will be exempt from IHT when you die. You can carry forward any unused part of the £3,000 exemption to the following year. But if you don't use it in that year, the carried over exemption expires. Use it or lose it. Now, the annual exemption of £3,000, by the way, folks, is in addition to the other gift exemptions. Let me share an example with you of these other exempt gifts. Now, some gifts made during your lifetime are exempt from IHT because the type of gift or the reason for making it. Let's consider gifts in respect of a wedding or civil partnership ceremony. Now, when you have a wedding or civil partnership ceremony, gifts are exempt from IHT subject to certain limits. Now, these are gifts in consideration of marriage. Parents can each give cash or gifts worth £5,000. Grandparents and other relatives can each give cash or gifts worth £2,500. And anyone else can give cash or gifts worth £1,000. Now, that may not be the motivation for making that gift, but it's useful to be aware of that. You must give the gift or promise to make it or shortly before the date of the wedding or civil partnership. Making that promise after the event, technically speaking, negates that. If the ceremony is called off and you still make the gift, or if you make the gift after the ceremony without having promised it first, the exemption won't apply. So gifts in consideration of, but technically speaking, it's going to be made before that ceremony takes place or is abandoned, which hopefully it won't be. Now let's think about small gifts. You can make small gifts up to the value of £250 to as many people as you like in any one tax year. However, you can't give a large sum and claim exemption for the first £250. It's all or nothing. You can't use your small gifts allowance together with any other exemption when giving to the same person. So regular gifts or payments that are part of your normal expenditure aren't also taken into account. Now let's revisit and talk about this 7-year rule, which is often bandied about. And I'm going to be talking about something called PETS, which stands for potentially exempt transfers. Any gifts that you make to individuals will be exempt from inheritance tax as long as you live for 7 years after making the gift. Now, these sorts of gifts are known as PETS or potentially exempt transfers. The idea being, if you survive 7 years, it drops out completely. If you die within that 7-year period and the total value of gifts you make is less than the IHT threshold, then the value of the gift is added to your estate. Any tax due is paid out of the estate. Now, one thing to bear in mind, by the way, folks, is when it comes to insurance. If you have an insurance policy and it's written into what's called trust, then one primary advantage of writing that life insurance policy into trust that all the proceeds are normally exempt from IHT. That means the payout from the insurance policy goes directly to the beneficiaries and is not considered as part of your estate, thus avoiding inheritance tax. Talk to your insurance broker to actually make sure that's in place. Now, the other type we have are gifts into trusts, and there's a whole wide variety of trusts out there. Now, gifts into trust are not generally exempt from IHT tax. Slight exemption when it comes to disabled persons trusts, but in general terms, the transfer into a trust counts as something, not a PET, but what's called a chargeable lifetime transfer. Now, just as a rule of thumb, if you make a gift into that's a chargeable lifetime transfer, essentially a gift into a trust, if it goes over $325,000 during that period of time, you pay half the rate at 20%. Now, what's really important to consider, and maybe something you might not be doing now, but do it, is if you are making those gifts, you are making those transfers, make sure you've got good, appropriate records to back up that inevitable time when you have to do probate, fill in the relevant IHT forms here. You need to make sure you've got good, adequate records to back things up. Now, not many of us think of doing that here, but I would suggest that's something you need to do, that if you do make those gifts, make those transfers, you've got it noted somewhere. This will show that the gifts are regular, that you've evidenced them, and you can support, or your executors can support, any tax claim that's being made. Now, folks, I hope you found this useful. I know death and taxes, those inevitable things in life, aren't things we normally like to talk about, but it's important here to plan your life such that you enjoy it, you make sure you give the maximum to whatever beneficiaries you choose, and that you minimise the tax burden on yourself and your estate when that time comes. If you need to discuss this further, please check out the show notes here, book a call, talk to your current accountant, but make sure you start thinking about that before it's too late. And one thing to note, it's never too late. You can always do IHT planning when you're no longer here.